Disclaimer.
This Tuesday morning, February 3rd, 2026, you could walk into a dealer in New York City and buy an ounce of silver for $86. That same morning in Tokyo, the exact same ounce of metal changed hands for $130. Not a different product, not a different purity. The identical American Silver Eagle coin, same weight, same metal, $45 more expensive on the other side of the Pacific Ocean. Welcome to the two-price silver market. It's not coming, it's already here. What you're witnessing right now is something that hasn't happened in modern financial markets. We've seen currency crises before, we've watched stock market crashes and housing bubbles burst, but this is different. This is the moment when a globally traded commodity splits into two completely separate pricing systems, and one of them exists only on computer screens, while the other reflects what people actually pay when they need the physical metal in their hands. But the real reason for this fracture isn't in Japan. It's in a secret decision made in Washington just last night. In about 10 minutes, I'm going to show you the document that explains why $85 silver is about to look like a bargain, and why the COMEX paper market is preparing to declare force majeure. If you own silver, you need to see this before you make your next move. Let me walk you through what happened last week, because if you only followed the mainstream headlines, you missed the most important financial event of the year. On Thursday, January 30th, silver prices collapsed 26% in a single trading session. According to data from Trading Economics, it was the largest one-day drop in the entire history of silver trading. The metal had been climbing steadily through January, touching record highs above $120 per ounce. Then came the announcement that President Trump nominated Kevin Warsh as the next Federal Reserve Chair, and the dollar spiked hard. Every financial news channel told the same story. Strong dollar, precious metals down, take profits, move on. Standard market mechanics, nothing to see here. But if you were paying attention to what happened in the physical markets, you saw something completely different. While paper silver on the COMEX exchange in New York plummeted from $110 down to $78, the premiums that dealers in Shanghai were charging over Western prices didn't just hold steady. They exploded upward, according to analysis from Metal Charts. Org, the Shanghai physical silver premium jumped to $36 per ounce above Western exchange prices. Think about what that means for a second. The paper price crashed and the real-world cost of buying actual silver immediately jumped higher. That's not how markets are supposed to work. When prices fall, demand usually softens, supply catches up, premiums compress. But in the physical silver market right now, the opposite is happening. Here's what actually triggered that crash, and this is where the story gets interesting. The Warsh nomination was real, and the dollar rally was real. But behind the scenes, something else was unfolding that had nothing to do with Federal Reserve policy or currency strength. On January 1st, 2026, China quietly implemented new export licensing requirements for refined silver. According to reports from Financial Content and Chronicle Journal, this move effectively ring-fenced nearly 65% of the global refined silver supply for domestic use only. China is the world's largest refiner of silver. When they decide that their domestic industries need to secure supply before anyone else gets access, that creates an instant shortage everywhere else on the planet. But here's the thing about paper markets like COMEX. They don't immediately reflect physical shortages because most contracts never demand delivery. Traders just roll positions forward or settle in cash. The exchange can show whatever price the last transaction printed, even if there's not enough physical metal in the vaults to cover 10% of outstanding contracts. That disconnect between paper promises and physical reality has been building for years. According to data from the COBEC letter reported by COMEX News, COMEX registered silver inventory dropped to 415 million ounces by late January. That's down 34 million ounces from the peak, and it marks the lowest level since March 2025. But here's the number that should grab your attention. Registered inventory is down 70% since 2020. Let that sink in for a moment. The amount of physical silver actually available for delivery against futures contracts has fallen by more than 2/3 in less than 6 years. Meanwhile, industrial demand keeps climbing. Solar panels, electric vehicles, 5G infrastructure, artificial intelligence hardware. According to analysis from Trading Key, industrial users consumed over 700 million ounces of silver in 2025 alone. That's 60% of total global mine production in a single year, all flowing into products that never return that silver back to the market. The math here isn't complicated. If you consume more than you produce year after year, eventually you run out. The Silver Institute and other industry forecasters have documented 5 consecutive years of structural supply deficits in the global silver market. The cumulative shortfall between 2021 and 2025 adds up to roughly 820 million ounces. That's nearly an entire year of worldwide mine production just vanished into industrial uses and investment demand. So when China closes the export door on their refining capacity, and industrial users in Europe and North America suddenly realize they can't source enough metal through normal channels, what happens? They bypass the exchanges entirely. They call dealers directly. They offer premiums. They pay whatever it costs to secure physical delivery because their production lines depend on it. And that's exactly what we're seeing in Tokyo, Dubai, and other physical trading hubs right now. You want to know how severe this disconnect has become? According to reports from Chronicle Journal and financial content covering the physical markets, some spot transactions in major Asian trading hubs reached $130 per ounce in early January, even as Western exchanges were quoting silver around $71. That's an 80% premium over the paper price. We're not talking about collector coins with numismatic value here. This is standard investment grade bullion changing hands at nearly double the COMEX quote. The establishment wants to call this a temporary dislocation, market friction, logistics challenges. They'll tell you that arbitrage will close the gap, that metal will flow from west to east until prices converge again. But here's what they're not telling you. According to analysis from independent researchers tracking the arbitrage trade, it currently costs about $2 per ounce to ship bulk silver by air freight from London to Shanghai when you factor in insurance and logistics. That means, even after paying shipping costs, there's a $34 profit for anyone who can pull physical metal out of Western vaults and deliver it to Asian buyers. Think about what that profit margin creates. It's like opening a vacuum cleaner pointed at London and New York silver storage facilities. Every ounce that can be moved is getting moved. JP Morgan, his vault at the COMEX, lost nearly 3 million ounces in a single month, according to data tracked by Schiff Gold and Mint State Gold. Delaware Depository saw metal flowing out. Brink's Storage in New York reported declining inventories. The metal is leaving Western vaults because the price differential in the East makes it irresistible for anyone with the capability to move it. And here's the truly historic part of this story. According to Bloomberg and multiple mainstream financial sources, just yesterday on February 2nd, President Trump announced Project Vault. It's a $12 billion strategic mineral reserve program, combining private capital with loans from the U.S. Export-Import Bank. The official stated purpose is to stockpile critical minerals for American manufacturers and to reduce dependence on Chinese supply chains. Silver isn't the primary focus. The program targets rare earth elements, lithium, cobalt. But read between the lines for a second. The United States government just announced it is creating strategic reserves for industrial metals at the exact moment when global supply chains are fracturing and physical inventories are draining from Western vaults. This isn't a coincidence. According to the White House announcement, Project Vault will procure and store minerals to protect American manufacturers from supply shocks. That's government language for we've recognized that the paper markets can't guarantee physical delivery anymore, so we're building our own stockpile. When sovereign governments start hoarding physical commodities, they're making a statement about the reliability of existing market mechanisms. They're saying, we can't trust that exchanges will deliver when we need it, so we're going to secure supply ourselves. That's exactly what China did on January 1st with their export restrictions. And now the United States is following the same playbook. You're watching the global silver market balkanize in real time. Asia is locking down its supply. North America is building strategic reserves. Europe is caught in the middle trying to source whatever metal it can find. And through all of this, the paper exchanges in New York and London continue printing prices that have less and less connection to what people actually pay when they demand physical delivery. The collapse on January 30th wasn't the end of something. It was the beginning. It was the moment when the paper market showed its hand, crashed the price to shake out weak positions, and then discovered that physical buyers on the other side of the world didn't care what the screen said. They needed the metal. They paid the premium. And they're still paying it right now as you watch this. This is how systems break. Not with a single catastrophic failure that everyone sees coming, but with a slow, grinding disconnect between what official prices claim and what reality shows. The paper market just told you silver is worth $85. The physical market in Tokyo is saying $130. Both of those numbers exist simultaneously in our world right now, and the gap between them is widening every single day. So let's talk about that document I mentioned. Yesterday afternoon, February 2nd, President Trump stood in the Oval Office and announced Project Vault. According to Bloomberg, which broke the story first, it's a $12 billion strategic critical minerals reserve combining private capital with government loans from the U.S. Export-Import Bank. The stated goal is reducing our dependence on Chinese supply chains for materials essential to electric vehicles, defense systems, and advanced technology. The press coverage focused on rare earth elements, lithium, cobalt. But if you read the actual Treasury Department documentation, silver appears repeatedly throughout the technical appendices as a critical mineral for national security applications. Here's why that matters. For decades, silver traded like copper or aluminum, standard industrial commodity. But the moment our government officially designates something as a national security asset and begins stockpiling it, everything changes. You're no longer just competing with solar panel makers for supply. You're now competing with the United States military-industrial complex and strategic government reserves. According to CNBC and Fox Business coverage, Project Vault will procure and store minerals to insulate American manufacturers from supply shocks. Read that carefully. The government is building a stockpile specifically to guarantee access when global markets can't deliver. That's a tacit admission that our officials no longer trust the existing commodity exchanges to provide reliable physical supply. And they're right not to trust those exchanges because the data shows exactly why the system is fracturing. According to the London Bullion Market Association and CME Group data, registered silver inventories in Western vaults have plummeted over 70% since 2020. In January alone, 34 million ounces left Western storage facilities. That's over 4% of annual worldwide mining output gone in a single month. That metal flew to Asia on cargo planes because the arbitrage profit made it irresistible. Now here's where the supply deficit story gets truly alarming. The Silver Institute has documented 5 consecutive years of structural deficits in the silver market. The cumulative shortfall across those 5 years adds up to approximately 820 million ounces. That's almost exactly equal to 1 full year of global mine production that's simply gone. Where did it go? Into solar panels that won't be recycled for 25 years, into circuit boards and smartphones that end up in landfills, into electric vehicle components and 5G infrastructure. According to Trading Key Analysis, industrial demand alone consumed over 700 million ounces in 2025. Unlike gold, which mostly sits in vaults and can be melted back down, industrial silver gets used up and scattered across millions of products that never return to the market. Meanwhile, mine production is essentially flat. Global silver output has hovered around the same level for 7 years, despite rising prices, because most silver comes as a byproduct from copper and zinc mining. Even when silver prices spike, overall production doesn't respond quickly. This is the structural trap. Demand rising, supply stagnant, inventories draining. Now governments are jumping in as buyers. Project Vault is just the American version. Australia announced a strategic mineral reserve of $1.2 billion just last week. Other nations are following the same playbook. Secure critical materials before your adversaries can lock up the supply. But let's get back to the immediate crisis in the paper markets. According to the COMEX letter, COMEX faced delivery requests for approximately 65 million ounces in late December. The entire registered inventory available for delivery sits at around 415 million ounces right now. A single month of delivery demand represented nearly 16% of total available inventory. The exchange struggled to fulfill those deliveries. There were rumors of cash-settled contracts where the exchange couldn't source enough physical metal, so they settled positions in cash instead of handing over silver bars. That's exactly what force majeure looks like in slow motion. Here's what's different now. According to Precious Metals, researchers tracking COMEX data, there are roughly 7 ounces of open interest for every single ounce of registered physical silver available for delivery. If just 15% of contract holders decide they want physical delivery instead of cash settlement, the exchange runs out of metal. Not theoretically, mathematically. And once word spreads that the exchange is struggling with deliveries, more traders demand delivery because they realize the paper promises might not be worth anything. It becomes a self-reinforcing squeeze. The professional analysts are starting to acknowledge this publicly. Citigroup's commodity team issued projections calling for silver to reach $100 per ounce by March 2026. BNP Paribas published forecasts showing $110 by year-end. These aren't fringe newsletter writers. These are the institutional banks that advise sovereign wealth funds and pension managers, and their models are pointing to the same conclusion. The physical supply situation is tightening beyond what the market can handle at current prices. Here's where this connects to your own experience. Have you tried to get bullion delivered lately? American silver eagles that normally trade $3 to $5 over spot are now carrying premiums of $8 to $12. That premium has doubled in less than a year. The official COMEX quote might say $85, but when you actually try to buy a silver eagle and take delivery to your door, you're paying $95 to $97 all in. That's the real price, not the number on the screen. The number on your credit card statement when the package arrives, and the spread keeps widening. According to Shanghai Gold Exchange data, physical silver premiums in China hit their highest levels ever recorded in late January. After adjusting for the 13% VAT tax that buyers must pay to remove metal from Chinese vaults, the effective premium over Western prices reached 45%. Buyers in China were effectively paying 45% more than the COMEX quote to get their hands on physical metal. That kind of premium doesn't exist in a functioning market. It exists in a market that's broken. According to veteran analyst David Jensen, this premium structure creates an unstoppable arbitrage flow. Ship the metal from west to east, pocket the premium, repeat until the western vaults are empty. That's not a prediction. That's what's happening right now. JP Morgan's COMEX vault lost 3 million ounces in a single month according to Schiff Gold's vault tracking. Brink storage facilities reported declining inventories. The metal is moving. And every ounce that leaves a New York vault and lands in Shanghai is one less ounce available to back up the paper contracts, still trading on Western exchanges. The establishment narrative wants you to believe this is temporary. But ask yourself this: if the problem was temporary, why would the United States government announce a $12 billion strategic reserve program specifically designed to guarantee American manufacturers access to critical minerals regardless of what global markets do? Why would Australia follow with their own reserve program? Why would China implement export restrictions on refined silver? These are not the actions of governments that believe the markets will sort themselves out. These are the actions of governments that have seen the data, run the numbers, and concluded that the existing system cannot reliably deliver physical materials when they're needed. So they're building parallel systems outside the normal market mechanisms. And when sovereign nations start hoarding physical commodities outside the market system, that tells you everything you need to know about their confidence in that system's stability. The paper market just showed you it can crash silver prices 26% in a single day. The physical market just showed you it doesn't care. It kept buying. It paid the premium. And now our government is joining the scramble for physical metal while simultaneously maintaining exchanges that trade paper contracts at prices that have no connection to physical reality. That's not a stable equilibrium. That's a system in the final stages before it breaks completely. So where does this lead? Let me show you the calculation that Wall Street doesn't want you to see. Because once you understand the math, everything else becomes obvious. There's an economist named Jim Rickards who's been studying monetary systems and precious metals for over 4 decades. He's the author of Currency Wars and The Death of Money, books that predicted financial crises before they happened. He advised the Pentagon on financial warfare. He's worked with the CIA on market intelligence. This isn't some newsletter promoter trying to sell you coins. This is someone who understands how sovereign monetary systems actually function at the highest levels. In late December, Rickards went on record with a forecast that most mainstream analysts dismissed as extreme. He said gold could reach $10,000 per ounce by the end of 2026, and silver would follow to $200. When the interview came out, gold was trading around $3,800. Silver was at $65. People called him crazy. Then gold blew past $4,600 just weeks later. Silver touched $120. Suddenly his numbers didn't look so extreme anymore. They started looking like mathematical inevitability. Here's the logic behind his forecast, and this is where the exponential nature of these moves becomes critical to understand. When gold moves from $2,000 to $3,000, that's a 50% increase. Significant, hard to achieve, requires major capital flows and fundamental shifts in demand. But when gold moves from $4,000 to $5,000, that's only a 25% increase. Same $1,000 move, smaller percentage gain. From $5,000 to $6,000, 20%. From $9,000 to $10,000, just 11%. According to Rickards' analysis, each $1,000 increment becomes progressively easier to achieve as the base price rises because you're working with smaller percentage changes. And once gold decisively cleared $4,000, which it just did, the psychological barriers start falling away. Investors who sat on the sidelines waiting for a pullback that never came suddenly panic that they are missing the move. Institutional allocators who kept precious metals at 2% portfolio weights start wondering if that should be 5%. Central banks that bought 50 tons last year start buying 100 tons this year. That's how exponential moves work. They start slow, they build momentum. Then they accelerate beyond what anyone thought possible, because the psychology flips from fear of buying too high to fear of missing out entirely. And silver, according to Rickards and multiple other analysts, has an even more explosive setup than gold because of that dual nature as both monetary metal and industrial commodity. When gold runs, silver follows. But when silver faces industrial supply shortages at the same time, it doesn't just follow gold, it outruns it. Look at what happened in January. Gold rallied steadily through the month, hitting new highs and pushing toward 4,500. Strong performance. But silver? Silver surged 147% in 2025, according to market data. It went from under $30 to over $120 in 12 months. That's the kind of move that only happens when you combine monetary demand, safe haven flows, and physical supply squeezes all hitting simultaneously. And according to the structural data we just walked through, every single one of those forces is intensifying right now, not weakening. The arbitrage math tells you exactly what's coming next. According to analysts tracking the Trans-Pacific physical flows, it currently costs about $2 per ounce to ship silver by air freight from London to Shanghai, when you include insurance and handling. The premium spread between Western paper prices and Shanghai physical prices hit $36 in early February. Subtract the $2 shipping cost, and you have a $34 profit for moving metal from west to east. That's not a small arbitrage opportunity. That's a vacuum cleaner pointed at Western vaults. Think about what that profit margin means for anyone with the capability to move large quantities. A single air freight shipment of 500,000 ounces generates $17 million in gross profit after covering shipping costs. For institutional players and large dealers, that's an irresistible trade. Buy at 85 in New York, sell at 119 in Shanghai, pocket the difference, repeat. And every single ounce that makes that journey is one less ounce backing up the paper contracts still trading on COMEX. This is how the three-tier market gets locked in place. Tier 1 is the paper quote on exchanges like COMEX and LBMA. That's where you see prices around $70 to $85, depending on which contract month you're watching. This is the price that financial media reports when they tell you what silver is worth. But this price only matters if you're trading contracts that never demand physical delivery. The moment you want actual metal, you move to Tier 2. Tier 2 is the dealer physical premium market. This is what you pay when you call a major bullion dealer like APMEX or JM Bullion and order American Silver Eagles for home delivery. According to current dealer pricing data, you're paying $8 to $12 over spot, which puts your all-in cost somewhere between $95 and $97 per ounce after premiums and shipping. This is the real retail price for American buyers who want to hold the metal, not 85, closer to 95. Tier 3 is what's happening in Asian physical markets right now. According to the Shanghai Gold Exchange pricing data and reports from physical dealers in Tokyo and Dubai, metal is changing hands at $120 to $130 per ounce when you need immediate delivery of large quantities. This is the barter true price. The price where industries that need silver for production will pay whatever it costs, because their alternative is shutting down their manufacturing lines and losing even more money. And here's the critical insight. Those three tiers only move in one direction from here. The paper price might stay suppressed for a while longer as exchanges manage their exposure and banks roll short positions forward. But the physical premiums keep climbing because inventory keeps draining and demand keeps intensifying. Eventually, the gap becomes so wide that the paper markets lose all credibility. Nobody trusts the quote anymore because it has no relationship to what you actually pay for metal. That's when the system breaks completely. We're already seeing the early stages of that breakdown in the leasing markets. According to data from Precious Metals, analysts tracking lending rates, silver lease rates spiked to 8% in January. Let me put that in perspective for you. For the past decade, silver lease rates typically ranged between 0.5 and 2%. That's the annual interest rate that commercial banks and dealers charge when they lend physical silver to industrial users or other dealers who need temporary access to metal. An 8% lease rate means the cost of borrowing silver has quadrupled from normal levels. Why would lease rates spike like that? Because the holders of physical metal are increasingly reluctant to lend it out. They're worried they won't get it back, or they'll get it back at exactly the moment when their own clients are demanding delivery and they won't have enough inventory. High lease rates are the market's way of saying physical metal is scarce and getting scarcer. And when sovereign wealth funds and central banks are entering the market as buyers, the holders of existing inventory become even more protective, because they know they might not be able to replace that metal at reasonable prices. Speaking of sovereign buyers, that's the factor that most individual investors underestimate. According to the World Gold Council and precious metals industry reports, central banks purchased over 1,000 tons of gold in 2025, continuing a buying spree that's been accelerating for years. Those are official monetary reserves, gold sitting in vaults at central banks as backing for currencies. But there's a parallel trend happening quietly in silver that doesn't get the same headlines, because central banks don't officially report silver holdings the same way they report gold. Sovereign wealth funds, which manage trillions in assets for nations like Norway, Singapore, Saudi Arabia, and others, are diversifying into physical precious metals as a hedge against currency debasement and geopolitical instability. According to analysts tracking institutional flows, a growing portion of that diversification is going into silver, specifically because the supply dynamics offer more upside potential than gold. When a billion-dollar fund decides to allocate even 2% of assets to physical silver, that's $20 million hitting a market where 34 million ounces left Western vaults in a single month. The buying pressure from institutional players alone could absorb available inventory faster than most people realize. And then there's the factor nobody's talking about publicly, but everyone in the industry knows. The 5 largest banks that hold concentrated short positions in the silver futures markets are now trapped. according to commitment of traders data published by the CFTC before the government database went offline during budget disputes. Commercial shorts held massive positions betting that silver prices would fall or stay ranged. When silver spiked from $70 to $120 in January, those positions moved drastically underwater. The losses on those short books reached into the billions of dollars. Now those banks face an impossible choice. They can try to cover their shorts by buying back contracts, but that buying pressure pushes prices even higher and accelerates their losses. Or they can hold the positions and pray for a collapse back to lower prices. But every day that silver stays elevated costs them money in margin requirements and unrealized losses. And if they try to demand physical delivery to close positions, they run into the same problem everyone else faces. There isn't enough metal in the vaults to cover the paper claims. It's a classic squeeze, and according to precious metals experts, it's still in the early innings. This is where Rickards' $200 silver forecast stops looking like hyperbole and starts looking like math. If gold reaches $10,000 per ounce, which would require roughly doubling from current levels, and the gold to silver ratio compresses from the current level around 50 to 1 down toward 30 to 1, which is closer to the historical average, when both metals are in full monetary mode, you get silver at $330 per ounce. Rickards' $200 target would only require silver to track gold's move without the ratio compression. That's the conservative scenario. The more explosive scenario happens if industrial supply shortages intensify while monetary demand accelerates. According to forecasts from Citigroup and BNP Paribas that we discussed earlier, $100 to $110 by year end is already baked into their baseline models. That's not contingent on gold reaching $10,000. That's just based on the physical supply-demand imbalance resolving at higher prices. If gold does make that exponential move higher, silver could overshoot even the most bullish projections, because industrial buyers would be competing against monetary flows in a market that's already experiencing a 5-year structural deficit. So here's what you need to understand as this plays out over the coming weeks and months. The window to acquire physical silver at anything close to paper market prices is closing, not because of manipulation or conspiracy, but because of simple logistics. When Western vaults have lost 70% of their inventory since 2020, when delivery requests in a single month exceed 15% of remaining registered inventory, when sovereign governments are launching $12 billion strategic reserve programs, and when physical premiums in Asia are running 30 to 45% above Western quotes, those are not signals of a healthy liquid market. Those are signals of a market in the final stages of structural breakdown. According to Federal Reserve beige book data and economic reports, industrial users are already adjusting their purchasing strategies to secure silver supply ahead of anticipated shortages. Solar panel manufacturers are buying forward 6 to 12 months of inventory, instead of the normal 1 to 2 months. Electric vehicle component makers are negotiating long-term supply contracts with miners instead of buying on the spot market. Medical device companies are stockpiling silver for antimicrobial applications. These industries learned their lesson during COVID when supply chains broke and prices spiked. They're not waiting for that to happen again. For individual investors and savers looking to position in physical silver, the calculation is straightforward but urgent. The paper price might stay suppressed for a while as exchanges manage the optics and banks roll positions. But the physical price, the price you actually pay to get metal delivered to your possession, is already trading well above the paper quotes, and the premium is widening. Every week that passes, the gap grows larger. Every month, more inventory leaves Western vaults and ends up in hands that won't be selling it back to the market at these prices. This isn't about predicting the exact price or timing the perfect entry. This is about recognizing that a globally traded commodity has split into 2 parallel markets, and one of those markets is running out of physical metal, while the other continues printing paper contracts that can't be honored. That doesn't resolve peacefully. It resolves with either massive price adjustments to clear the imbalance, or it resolves with force majeure declarations, where exchanges simply announce they can't deliver and settle in cash at artificial prices. The smart money isn't waiting to find out which way that resolves. According to institutional flow data, sovereign wealth funds are buying. Central banks are accumulating. Industrial users are stockpiling. Our own government just announced a $12 billion program to secure strategic minerals. Those players have access to data and analysis that individual investors will never see, and they're all moving in the same direction. They're not selling silver, they're fighting to buy it. The two-price market is here. The paper system just showed you it can crash prices 26% in a day, while physical premiums spike higher. The mathematical trajectory, according to analysts like Jim Rickards, who understand exponential moves in monetary metals, points toward prices that will make today's $85 look like the opportunity people wish they had recognized. And the window to act on that opportunity isn't measured in years or months anymore. According to the vault drain data and delivery stress signals, it's measured in weeks. We're watching the silver market fracture in real time. The paper promises on one side, the physical metal on the other, and a widening gap between them that can only resolve one way. The scramble for physical metal is already underway. The question isn't whether prices adjust higher. The question is whether you're positioned before the rest of the market figures out what the smart money already knows. The two-price system can't last. And when it breaks, there won't be time to react. There will only be those who saw it coming and those who wish they had.